Hello everyone, this is Terry with Futures.io, and as always, I would like to thank you for joining us today. It's my pleasure to welcome back Peter Davies from Jigsaw Trading for today's webinar, 7 Most Effective Trading Setups. Throughout the webinar, if you have a question, please feel free to type them in the question box, and we'll do our best to answer them at the end of the event. This webinar will be recorded and posted on the Futures.io website within 24 to 48 hours. If you're watching this afterwards on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I'll hand it over to Pete, and you'll get a pop-up to share your screen again.
Where did it go?
Oh, yep, looking good. She's all yours, sir.
You got it. Great. Okay, so hello everybody. Thanks for coming. And this webinar doesn't need much of an introduction. We're going to look at 7 setups. For each of these setups, we're going to consider them from a few different aspects. We're going to look at when they work, so which market conditions. We'll look at why they work. In other words, why would buyers and sellers engage and move markets our way? Not all the time, but some of the time. We'll look at what confirms that the trade is setting up. We'll also look at how to confirm the trade is going your way and what you should see if the trade is failing. Now, with all of our webinars, there's always a hidden subtext. There's always like what we're showing you, and then there's what we're trying to teach you. So the goal here is really to take a look at some trade setups themselves, but also by the time we've finished, I'm hoping that you'll actually be able to go back and look at your own setups in a slightly different way, because although the setups I'm going to show you are different, you're going to see they're built up of similar building blocks, and your own setups will be the same too, whether you look at them that way or not at the moment. There's common elements that many of them share. Now, some of those elements might be elements used to enter. Some of them might be elements you use to manage your trade. Some of them might be elements you use to say, you know what, this is not working out. So at the end of this session, what I hope is that you've maybe got a new way to look at these particular setups, but also you'll be able to go back to your own setups and see them in a new light, make them work better for you, maybe throw 1 or 2 away. You know, I was talking to a trader today, and some of his setups, they're really hard to tell after he gets in whether they're working or not. And some of his setups, it's really clear after he gets in whether they're working or not. And my suggestion to him is like, why don't you just throw the first lot away? So they're better setups because, you know, the second lot are better setups because you've got a clear indication of whether it's working or not. There's no guesswork. If there's guesswork, you'll end up moving your stops, all that kind of thing. So, you know, maybe you'll throw 1 or 2 setups away. Maybe you'll replace them with some of the setups you see today. Maybe you'll improve yours. Now, what makes a good setup? You know this, if you don't know this, I actually work with a lot of prop firms. So I've got a fairly good idea of what they do, what the win rates are, and what they look for. So obviously one of the things, the first thing that makes a good setup is the ability to replicate it consistently, the ability to spot it in time. The frequency is important. So the more often you repeat something, the sooner you're going to become proficient at it. So if you have a setup that only comes once a year, then you're not going to get that much practice of it. Now, most setups work well in specific market conditions, and we'll see that today. Anyone that's been in the markets for the past 12 months will probably have seen things stop working as volatility has constantly been cycling up and down, and it's been quite a tough 12 months for a lot of new traders. Another thing that is interesting with a good setup is knowing who's on the other side of your trade. That's really important, as is knowing who's likely to be joining you if it works out. So not just knowing who, but also knowing how they're likely to trade and what sort of move their participation should generate. And in turn, that means having a way specific to each setup to know if it's working or not. So with some setups, you're going to be trading near an event that will cause a reaction, or that you think is going to cause a reaction from many traders. And that is usually something that's fairly easy to see. Did that reaction occur or not? Other setups, like range setups, you might be trading like at the end of a range and merely waiting for a reversion to mean. And the confirmation of that trade, generally speaking, it's a little bit harder to detect. It's kind of a lazy fallback into the range. So like I say, if you've got 2 setups and one has a clearer no-go on whether it's working or not, then everything else being equal, those ones are the better setups, right? So setups that are close to a tipping point or a decision-making point for the market are also better from a risk-reward perspective. And with the prop firms I speak to, and the prop firms I tend to talk to are the ones doing outright trading, which means they like buy to sell higher and sell to buy lower. In that environment, most of the traders there, they're looking for a skewed risk-reward ratio. So they're looking for a trade where the reward's a lot bigger than the risk, and they don't really care about the win rate, right? The win rate's really secondary to them. So it's not unusual for the top tier traders to have a win rate about 50%. I was talking to Merritt Black at SMB last week or the week before, and he hits about 40%, right? But the winners are just a lot bigger than the losers. And we've all had, and we've all get these still, right? You've all opened up your inbox in the morning and seen the spam emails promising systems with really, really high win rates, 90, 80%, 90%. And some of those spam emails, some of them just go to, they just go all out and up for 100%. And that does skew you, that does influence you. Seeing that kind of thing over and over, and looking out on the internet at all this talk about really high win rates, it does kind of sit in your psyche. So it is worth considering why the risk reward is more the focus for the firms trading outright positions than the win rate. So if you think about two setups, right, one of them has a 1 to 4 risk reward ratio. So every tick you risk, you're making 4 ticks. And the other one risks 8 ticks to make 4. Okay, so they're both looking for 4 ticks and they're both profitable, which is all good, right? And it's all good until you have a bad run. So with this first scenario, you don't really start to lose money until your win rate dips below 20%. But the other system is a lot less forgiving. So anything below 66% win rate and the losses start. Now, I know a trader doing this right now. He's trading ultra bonds. He's trading 10 lots a trade. He's getting out at 1 tick. So it's $30 a tick. So it's $320 a trade on his winning trades. So basically day in, day out, he makes money. And he's just, sometimes he just goes in, does one trade, makes 1 tick and stops for the day, right? So day in, day out is 320, 320, 320, 320. But every now and again, he takes a $5,000 loser, right? So now put yourself in the position of somebody who's making $320 a day and suddenly he's just had a 5K loss, right? How does that guy feel, right? What is his mental state? What about after 2 consecutive losses? He's now down $10,000. Mentally, can he afford another? Well, financially, can he afford another loss? But what's his rationale going to be? What's his mental state going to be? Because the next time he takes a trade, he needs that trade to win, right? He cannot afford to compound that losses. And the worst situation you want to find yourself in as a trader is, first of all, to have a big drawdown, but also to have a big drawdown and then need to rely on a high win rate to claw it back. Because quite often you're going to get into that drawdown situation because what you're doing isn't working so well. So like you've dug yourself a little bit of a hole by trying to apply a system in an environment, a market state that's not working so well. And you actually need winning trades to get out of that hole. And you know what's going to happen, right? You're going to start digging more of a hole. You're going to start, the mental games are coming into it. Now, this is an extreme example, but it does highlight the point, right? Most traders are looking for that holy grail system with a high win rate, but the goal should really be a high risk reward, right? And then, if you're in a system like this where you've got a break even of 20%, right? What's your goal there? Your goal is to exceed that 20%. And if you can get 50 or 60%, that's fantastic. You're going to really, make that sing and dance. And when you have a few winners, you're losing 1 unit for every 4 you make. If you have a few losers, you're losing 1 unit for every 4 you make on your winners. And it's going to take you a much longer time, a much longer and deeper losing streak to actually draw down your account, right? So that's really why the trades in the fresh environments that I kind of deal with, they're looking for an event that will actually have a big reaction if they're right, and will have a small reaction if they're wrong. Okay, so with that, we're going to look at a setup. And first thing you're going to notice, it isn't a chart, and even though a jigsaw, it isn't a dome either. So the first thing I want to do today is forget about the market as something that moves from left to right, and think of it as something that moves up and down, which is really the reality of it, right? So a market where at any point, some people are long and some people are short, where things like time frames are not important. It doesn't matter 1 minute, 3 minutes, 60 minutes, it doesn't make a lot of difference. All that we have at any point in time is traders positioned and traders looking to add, increase or exit positions. That's all we've got in the market, right? Nothing more than that. Now on this diagram, the line is showing us where we traded so far, and the oval just represents an area of extra volume, an area of high volume. So in other words, this egg-shaped oval here, that's a trading range, an area we've been trading for a while where there's no evidence of the range breaking yet, obviously, because we haven't moved out through the top. So we've all seen trading ranges before. You probably saw one yesterday, in fact. Now, when we look at trading ranges, there's two types of trading range that I tend to look at. There's the kind of extended trading range, which is like, the market goes into a funk for 2, 3 hours, 4 hours, or even all day. The kind of thing where you're just like sitting on your hands thinking, when is this thing going to break? And then you have what I'd consider more micro trading ranges, where the market's had a push up and it just takes a breather, and then it forms a small micro range. It could be across 10 ticks on crude, could be across like 5, 6 ticks on the S&P, and those micro ranges tend to form as the market takes a breather in an overall trend. So you get a move, a little micro range, a move, a little micro range, a move, a little micro range, and then when the move's finally over, the micro range will break in the opposite direction to the trend, and that's usually when the reversal occurs. So in this case, all that matters is the market's been in a range for a while, and the volume is built here, and that volume is observable. It's obvious that there's more volume in this area than anywhere else in recent history. Now, the trade we're looking at is not a range trade, it's a pullback. So what we're looking for is this, right? So what we see, at some point, the range breaks to the upside, okay? And we're no longer in that range anymore. Next thing we see is the market pulls back to the top of the old range and then continues up from there, okay? That's the setup, but obviously there's a lot more to trading the setup than just that. That's just a basic, simple chart pattern, okay? So now we're going to look at different things we need to know about a setup to really trade it, right? So the first thing we need to know is, when does it work? Well, in a trending market, like I said, what tends to happen is you have breaks, and then you have a volume area build where you take a breather, you build some volume, and then it breaks out in the direction of the trend, right? And what you have in this area here of high volume is you've basically got people long and short in this area of high volume, in this range. So when you break to the upside, the shorts in that area get stopped out. And as you come back to that area, you're coming back to an area where shorts got stopped out, and it's usually a few minutes later, and the people who are short are less likely to engage to the short side in that same location, and other people that see the market broke to the upside, again, also a bit less likely to engage to the short side as well. Now, in a trending market, if we're breaking in the direction of the trend, it's much easier for traders overall to engage in the direction of the trend again. Okay, it's the path of least resistance. So we've got two things going on there. Shorts are going to be a bit shy because they've just stopped out, and it's the path of least resistance, right? If the market's been moving up and it ranges and breaks to the upside, then people say, you know what, I think it's going to go up again. Now, what confirmations are there, right? So what do we think we need to see in order to confirm this trade, right? So say we get in and we're already in, what does it want to see? Well, the first thing we should see is really something on the break here, right? So if we're relying on the fact that traders got stopped out, traders in this area here got stopped out, then we should see a stop run as we break to the upside here, right? So a stop run is generally defined as a rapid move up through the high. So you've got this area here. If it just very slowly ticks up very slowly and not much volume at each price on the way up, then that's probably not a stop run. But if we have a lot of volume, a lot of participation, a really aggressive move up through that top of that range, then it really, we can say, okay, that probably has broken to the upside. Okay, then that should mean that we've already seen people stop out. So it's a pop as we leave the range, some kind of explosive move, right? If there's no stop run, right? If it is just a lazy move up through here, then the premise for this trade is not really there, right? We haven't really seen the market play out the way we want it before the pullback, right? If it is working, what you're going to see as the market moves up, again, you'll see a move back down. You should see the market stop roughly, not exactly, around the top of the old high, and you should see some decent participation come in as traders realize that the market's now lifting off again, right? So if it comes back down, starts trading in the range, then you can say, actually, my premise for that trade isn't on. I saw a stop run to the upside as the market broke. It came back down, traded into my range, no follow through to the upside. If it is working, what you're going to see, the moment it starts to lift here, you're going to see traders jumping in on the long side, decent pace to the market. It's not going to be as fast as this break here, right? But you're going to start to see traders coming in and engaging, and you're going to see some decent pace in the market to the upside. So a little pop, not the big pop you saw here, but you're going to see a little pop there. So we've got, if it doesn't work, it's going to go back into the range. If it does work, we're going to see some kind of pop. Now, what's the risk reward? Well, in this one, the risk you've got here is simply a number of ticks back into that range. Could be like 3, 4, 5 ticks, depending on how good an entry you got here. It could be 3, 4, 5 ticks into the range, and that's your risk. The reward is somewhere above the old high. Okay, so your first target really is to get to the old high, and then your reward is really up until we make the next range and move up, and make the next range and move up. So the sky's the limit, really. Okay, so this is a trade where you have a really good risk reward, good upside potential. It's pretty clear where your risk is, and a trade where you absolutely do not need to be right all the time. Okay, so this trade could work 1 times out of 3, and it would still be good. Okay, reality of taking this trade is usually it's a little bit tough to time this trade, right? So obviously what you're going to be doing, the premium trade, you're going to be waiting for it to come back to the top of the old range. Typically, if you're not in one of the news-driven volatile days or a Trump tweet day, bit of volatility, then it'll come down, and quite often it'll just tag the price above the range on a market like the S&P or some of the treasuries, and you won't actually get in at that price. So you've got to give up 1 or 2 prices at least above the range, generally speaking. But really, it's just usually it's a timing issue. Sometimes you have to wait for it to lift off a little bit before you'll be getting in, and it can turn quite quickly at that point as well. Okay, so just that's the first setup. I hope then that makes sense in terms of the things we're going to ask ourselves during a trade. When does this trade work? Which is after a range. Why do we expect it to work? What are the pre-trade confirmations? What are the post-trade confirmations? Okay, let's look at another one, another pullback trade. Now, we have to stop here a second, because you might be thinking, well, we've just looked at a pullback and now we're looking at a pullback again, and aren't all pullbacks the same? Well, of course, all pullbacks have things in common, but there's also very specific entry triggers that play out differently, and that will become clear as we go on. So what have we got here? We've got a market that's moving upwards. We're not dealing with a case now where we've had a range. And what we see is the market moves down and it ends with a large amount of trading at 1 or more prices. Okay. Generally speaking, if you're looking at markets like the bonds, S&P, some currency futures, that can just be 1 price. If you're looking at crude, NASDAQ, it's going to be a few prices. Markets like DAX, it's really a tough trade. It's a very, very tough play for pullbacks. Now, as we get down to this area where we're churning a lot of volume, you're going to see that often that's going to be one-sided. So a lot of the times it will be a lot of selling being absorbed by the bidders. Now, it might be two-sided as well, So you could see a lot of trade on both sides. But if it is more one-sided, where you see a lot of selling but not much buying, and all those sellers getting stuck, that does, in my opinion, make it a slightly better trade. Okay, because the buyers are there, they're just sitting on the bid absorbing the selling. Okay, so what we're seeing here, generally speaking, is some kind of iceberg orders, and it means the bidders are trying to hide their size, although obviously in 2019 they can't do that anymore. So typically you'll see something like 2,000 contracts trade against 500 bids, and at the end there's still 500 bids remaining. So you'll see the bids are 500, and you'll just see the number of contracts trade increase up to 2,000, and there's still 500 bid. Okay, so we see that absorption, and then the market lifts up from there. Okay, when does this work? This works in trending markets. This does not work after a Trump tweet, right? So if it's a really volatile news-driven day, or Boris Johnson's just said something about Brexit, or Trump's just put out a tweet, you're going to find the market's a bit too erratic. So when you've got that really high volatility, what you tend to see is apparent iceberg orders that seem to have very little impact, right? So you get this very volatile environment, and you do see the sign that those icebergs are there, but they don't tend to stop the market. So it's kind of a normal paced trending market. Why does it work? Well, what we have, obviously, markets moved up. We've got counter trend sellers here on the way down, and then we've also got a bunch of counter trend sellers stuck in this area here. They can see it, you can see it, I can see it, everybody else can see it. It's an uptrending market. So sellers see the market's no longer moving down off their selling. They already know, because of the move up, that they're selling against the trend. And basically what will happen at some point, the sellers are going to start to bail out. Okay, and of course other people like you, people like me, pure speculators, are also going to see this, and depending on your risk appetite, people are actually going to buy into that and buy into that iceberg, because they think they think the market's going to move up, and the trap sellers are going to get bailed out. Now, time is also a factor with this, because icebergs take time to build, and lots of people can see that and join in. Okay, so this trade has a time element to it that we didn't have on the last trade. Okay, the time it takes the iceberg to build is a factor that just kind of helps in your confirmation. Now, as we lift away from this, traders are going to realize the path of least resistance is still to the upside, and that this is actually not a reversal to the downside after all. Okay, so what do we want to see for confirmation? Well, we want to see the iceberg, obviously. So after the move down, we're probably going to have an average or medium to slow pace down. We're going to see the iceberg order here, and we want to then see the market lift away, right? What we don't want to see a massive amount of volume on the way down, or a really fast move on the way down. Okay, we don't want to see a really strong move to the downside followed by an iceberg. Okay, we want to see a low volume, low interest move, and then the iceberg. And then if we get into this trade, what do we think we're going to see if this trade isn't working? Well, this is one of the best trades from a risk reward perspective, because with this trade, what you're looking for is a move below the iceberg. Okay, so if we move below the iceberg, that means the trade is in peril. Okay, the other sign of failure is any failure to get through the high. So if we come down here and then we start to move up like a lazy move up, and we don't get through this high, then we could just, it's kind of like a double bluff, right? Any sign of manipulation also. So if we see absorption up here, then again, that's a sign that there's manipulation and market's going to drive down again. If this is working, what do we expect to see? Well, unlike the other trade, we've got trap traders here, so we should absolutely see a pop as we move up. Okay, it's not massive because this iceberg might only be 2,000 or 3,000 contracts traded on S&P. If it's on crude, it might be like 500 contracts traded. So those trades, those positions, we're going to expect them to stop out. We're going to get a pop. Now, a lot of trades are like this. You should see an initial pop. So if you see the market move up and there's no pop, then that's really a trade that's in peril as well. So you could say, well, the market's moved up away from the iceberg, even though there's no pop and it's a lazy move up, then I'm going to stay with the trade. But that's really not the premise for your trade. The premise for your trade is traders got stuck here, so you expect them to stop out and you expect a pop. And there's a lot of trades like this where you should get an initial pop to confirm your trade. So until that pops come in, until you've actually seen that pop, then you've still got a trade in peril. But once you've seen that pop, then you can easier let the trade run out. Okay. So, you know, we're going to see a pop at some point, and then we should see traders jump in, decent pace as we move up through the high. Okay. And again, we should see fairly clear acceleration through the high. Okay. Right. Same scenario, different pullback, different layup, right? Different layup in terms of what we're going to expect to see to confirm the trade, right? So a fade is something that occurs when you just simply run out of people in one direction. It's the opposite of an iceberg order. So in an iceberg order, there's lots and lots of people selling, but they're just not getting anywhere, right? They're getting stuck. With a fade, it's a little bit more difficult to see, and that's actually what makes it a better trade, or it makes it a good trade, I should say. So think about it. With the iceberg trade, you're going to build volume, and that takes time. So during the time that you're building that volume, there's lots and lots of people that can see that and react to it. And more importantly, there are big players in the markets that can nudge things around, like those basic manipulation plays. So when you see thousands of contracts at a couple of prices, there's actually a bigger payoff in nudging people out of position, right? There's more interest there. So the fade trade is the opposite of that. And this is when there's hardly any contracts at prices. So if there's not many contracts trading at a few prices, there's actually no point nudging the market around, right? Nobody's going to move the market like 4 or 5 ticks to get your 3-lot contracts and stop you out, okay? So less chance of manipulation. So what happens is you have a market that moves down and then it slows down. So what you often see is you hit a price quite often, especially on thicker markets like the S&P, excuse me. You'll come down and you hit a price. You might trade 500 contracts and tick down, 400 contracts and tick down, 300 contracts and tick down, and you hit a price and like 30 contracts trade, and you tick back up, and you come back to the price where the 30 traded and 12 contracts trading, and quite often it is that obvious, you know, from 500 down to 12, right? So you see a handful of contracts trading, it will tick back, go back to that price again, and you just see hardly anything trading. Suddenly there's just no interest to the downside, okay? And then what you see is you eventually see the first trades, a few tentative trades to the upside, and it's not long before the path of least resistance is established again, okay? So when does this work? Okay, again, regular trending days. These kind of plays are really, really difficult. If like I say, if there's been a Trump tweet and the markets, the S&P has gone up, you know, vertically 20 points and then comes back down 3 points, this isn't the trade, the one to trade, but like a regular trending day. Okay, why it works? Obviously, if there's no one willing to sell anymore, the market won't just carry on down, right? I mean, it's not going to go up just because there's no sellers. You actually need buyers. So absolutely 100% sure, it could mean we're going to revert to a range, right? But you'll likely start to see buyers tentatively coming into the market. And it just takes a little bit of time, though, because not everybody jumps in at once, right? Because there's no stop out, right? Now, confirmations, really, in terms of confirmations as you're getting into the setups, it's really what you don't see that confirms. On the way down, you don't see big sellers. You don't see big downside momentum. You don't see large volume. And then you just get to a point where you see less and less in that counter trend move. Right, what do we expect to see if it isn't working? So we get into a trade, what are we going to see that's going to get us out of the trade? Well, first of all, a flood of sellers coming in. Okay, so if you think there's no sellers in the market and you see the sellers have gone and you wait 10, 15, 20 seconds and there's still no sellers, and you get in and a flood of sellers come in, just get out of the trade, right? Now, what I would also say is this is one of the trades where you could potentially get into a trade, get out because you see some sellers come in and get in a bit lower down. Okay, so if you're of the mindset that actually it still might continue to the upside, it is better to kind of get out of the one trade and get in a bit lower later on. And that's one of the reasons some of the prop traders have lower win rates, or what you would think would be a lower win rate, you know, like 50–40%. It's because some of the trades are just doing that. They're just getting into a market. Okay, I'm not seeing this, I'm going to get out. And there are other trades where they'll actually average down as the market moves against them. They'll actually average in. But also they will, if they think something's going to work and it moves against them, nothing wrong getting out and getting in a bit lower down. What to see if this is working? Well, what you're going to see, you don't have any pop, right? So as you move up, there's not going to be a pop. What you're going to see is the pace of trade is going to start to gradually increase, not that initial pop. And you're actually likely to see more acceleration as you get up to the top, right? As you get up to the top, you're going to see more people actually coming into the market as you reach the old high, just because it takes people a little bit of time to kind of join in. It takes people a little bit of time to realize what's going on and join in. Whereas with the iceberg, we already saw the market like stick at a price for like 3, 4, 5 minute churning volume. Everybody had time to see that and make a decision. Now, this seems like a poorer trade, right? Because it's a bit more vague, it's a bit harder to spot, but in some ways it's better than the iceberg, purely because of the lack of size traded at this point. There's not many sharks around. There's nobody to really take out. Okay, I'm going to go into a slightly different trade now, and this one, it's a trade. And it's also not a trade, right? So it's a trade in respect to, you could just trade this, but it's also not a trade in that you can use this in conjunction with prior pullback setups. Also could be your cue on range breaks as well, okay? So what we've got here, we've got correlated markets. Doesn't really matter which market it is. In my case, it's Dow, NASDAQ, and S&P. Could be interest rates, could be any 3 correlated markets. Okay, now I don't use 2 correlated markets. Usually for me, if I'm going to trade correlations, I want 2 or 3. I wouldn't really have 3 markets. I think 2 markets you can't really see with 2 markets where the correlations are broken down. Okay, so what you'll see with the Dow, NASDAQ, and S&P is when they all move together, you tend to get cleaner moves across all 3. Okay. If the Dow and the NASDAQ start going in different directions, what you'll often find is the S&P will be range bound. Okay, so the presumption here for this trade is that all 3 are moving together. So to take a trade based on correlations, you need to have them generally moving together. In this case, all pulling back, but obviously it's 3 different markets with 3 different levels of liquidity. They're all going to be pulling back to different degrees. Okay, and then what you'll see is 1 or 2 of them will pop to the upside. Now, if you look at Dow, NASDAQ, S&P, it's often the Dow or the NASDAQ that's going to move first, but that is a bit of an optical illusion, right? So if you picture the Dow, the NASDAQ, the S&P in your head, obviously you know that the S&P is thicker, right? So it takes longer for buying to become evident on the S&P in terms of a price move, right? So if buyers come into the Dow, the NASDAQ, and the NQ and the ES at the same time, the Dow and the NASDAQ will show price progression before the ES, but it's not really moving first, right? So if you think about it, if the S&P moves 1 tick, then the equivalent move on the NASDAQ is 4 or 5 ticks, right? 2 ticks on the S&P is about the same as an 8 to 10 tick move on NASDAQ and Dow, right? So when you see the NASDAQ or the Dow moving first, it's moving. It is. You can see it moving first, but it's an optical illusion, right? So the S&P might tick up 1 or 2 ticks. It doesn't actually look like it's moved on the chart, but what you see on the NASDAQ or the Dow is a move. It's a visible move because it's just a thinner market that moves more ticks than the S&P. Right. So when does this trade work? So this again is a trending market play. So when the path of the least resistance is the upside. Why does it work? Well, there's never a clear and consistent leader when looking at correlated markets, but arbitrage, spread trading, does keep markets together. Okay, so what you have to know for this trade is to know when correlation is on or off, right? So if they're all roughly moving together, that means the arbitrage trade is on. Okay, so it's the arbitrage trading that's going to pull your market along with the others if one of the markets breaks first. Okay, so what confirmations are there? Well, basically the two confirmations are they're generally moving together, and we can see one of the markets moving up. Okay, what do we expect to see if this trade isn't working? Well, we expect to see the market that led the move is going to start to tick down again. Now, the beauty of this trade is if this happens, if you're trading the thicker market, if this is NASDAQ here, Dow and S&P, if you get into a trade on the S&P, you see the NASDAQ start to move up, you see the Dow start to move up, you're in your long on the S&P, and then you see the Dow and the NASDAQ start to move down, you'll probably also find that you benefit from the fact that those two markets are more volatile and that the S&P hasn't actually moved down much yet. Okay, so you're actually taking advantage of the fact that you're trading the least volatile of those correlated markets, right? So you don't necessarily need your market to move against you to see the moves over. So what you're expecting is you're expecting the markets to pop up, you're expecting other traders to be trading that path of least resistance. You are not expecting these markets to move down. So if this market now moves below that low, then your correlation trade's probably done. Okay. Okay. If this is working, after they all start moving up, you should see the pace of the markets increase. Okay. So you've had the move down, you should see all three markets start to move up and the pace start to increase as other traders realize that we're going up again. Okay. Now the key to this trade is practice and pattern recognition. So this is a trade you're not going to get right on day one. You need to experience working and failed trades. The more you watch the three markets move together, the more confidence you're going to get in sorting out the winners from the losers before you get into the trades. Okay, so if you're sitting there anyway, watching the S&P, for instance, pull up the Dow and the NASDAQ and start watching the way they move together, especially when we get into a pullback and the other markets start moving up, and you'll just develop a feel over time of when the other markets are starting to actually lead a move, right? And if you're not right about this and they fall over, if you trade the thicker market, if you trade in the S&P, you'll be in a situation where the S&P actually hasn't fallen back that much when the other two markets fail in the move or fail to follow through. Okay, enough pullbacks. We've had enough of those. What we're going to look at now is a range fade. Now, if you're trading index futures, the first sign of the markets reverting to range is the correlations breaking down. So if you're trading S&P, the first thing you should do when the NASDAQ starts going up and the Dow starts going down is start to revert to range bound behavior. The other thing you want to be doing, especially like right now where we're in this kind of news addicted phase, on the days where the news is very quiet, when we're really low on news, we're tending to be more range bound now. So as well as looking for correlation breakdowns, as well as looking for market reverting to a range, really nowadays it's not enough at the moment with the certainly for the past 6 months with all the news we've got on. You have to have some kind of expectation of volatility going into a day, right? So if you're going into a day like today and there's news on Brexit and all that kind of thing, you're going to expect high volatility. On the flip side, if we're low on news, market's tending to die out, right? So with the range trades, keep an eye on the news before the market opens and keep an eye on the news as you get through the day. Okay, so what do we see when we start to build a range? So as the market's moving, what you tend to see is large volume first at one or two prices, and then you start crossing over that price up and down from above and below, and you just start to build volume. It's a bit like twirling candy floss in the candy floss machine. You just gather a little bit of volume at a couple of prices and just cross it over from above and below. And again, if you're not watching this, if you're always sitting there wondering whether the market's reversing to a range, just keep your eye on the volume at price. And when you go up to when you're trading, say a market's moved up, just look for really big volume at one or two prices and watch the market cross back below it and cross above it, and you'll see it'll just start to spin around those two prices. So look for exceptional volume at a narrow range of prices and crossing from above and below. Because with the range trade, you don't want to be fading the range on the 10th hit of the extreme, right? The earlier you can get into the range, the better, which means if you can recognize the kind of birth of a range, you're going to be better set to take the earlier hits to the extremes. Next thing we want to understand about range is they are not exact. They are the least exact trades, right? So sometimes you'll poke through the top of the range, sometimes you'll fall short. Size of the range is really important. If you've got a 3-tick range, very, very difficult to play. If it's 8 ticks or 10 ticks or 20 ticks, then the potential reward is worth the risk. So the key to a range fade, spot the range early, ignore the smaller ranges. If you start playing smaller ranges, you will be in a position where you actually need a high win rate to make money, okay? And there's no need to put yourself in that situation. So there's 2 types of range to play. There's the short-term range within a trend, okay? So again, as I say, the markets do tend to push and then range and then push and then range. And then there's a longer-term range in a slow directionless market. With the first type, you generally expect to break with the trend. So if your market's moved up and you've just spent 10 minutes and you're spending 10 minutes in a small range, you kind of generally expect the market to carry on up, right? So it's worth considering only playing one side of the range, so you're not on the wrong side of the break. For the longer term range, you can play both sides, but a lot of traders I talk to find reversing a position difficult, right? I'm not sure why that is, but a lot of traders want to take a range trade from one extreme, get out of the other extreme, and step back. What they don't want to do is get at the bottom and reverse at the top and reverse again and reverse again. Now, I'm not sure why, because it does, if you think about it, if I get out at the top of the range, it means I think the move's over. Logically, you know, forget how we feel, but logically, you should reverse the trade, right? But I don't know many traders that can do that, right? So that's up to you. So generally speaking, range trades are from one extreme to the other. Okay, so what's the range fade? Well, you buy, like I say, what you consider to be the high or the low of the range this time round. Quite often, you're going to see one of the signs we've already discussed. So you could see an iceberg close to one of the extremes, which means, again, you've got a good risk reward because you can get out just above the iceberg. Could be you simply run out of traders. You just get to the opposite end of the range and it just stops. Okay. Could be that you trade in S&P and you see one of the correlated markets start to move down. And this is where it should start to become evident that the previous setups we discussed are made of building blocks, right? And we can use some of those building blocks on other setups, right? Every setup doesn't have to be unique. So an iceberg holding the extreme at the end of a range is an easier layup, right? To get to the other side. So when do range trade works? Well, one, when there's a pause in a trend, pause in a short-term range, and two, when there's a general lack of news or interest, or before FOMC, or just a time when people are waiting and seeing, right? Why do they work? Well, with ranges, they basically work till they don't, right? There's no commitment either way in the market, right? There's nothing going on that is able to push buyers and sellers outside of a comfort zone. So it's kind of discomfort outside of that range area. What confirmations are there? Well, we get icebergs, excessive volume at the extreme, a fade at the extreme, correlated markets changing the extreme. Sometimes it just gets to the top and rolls over, right? What do you expect to see if it isn't working, right? So if a fade of a range isn't working, one of the first things that's going to say it isn't working if you get really aggressive trading into and through the extreme, right? So if you fade a range and then buyers just whack into the market, then it's not really a trade. You just want to say, well, I'll wait and see, right? The other thing that I tend to notice a lot is failure to get through the POC of that range. So point of control is generally it's the highest traded price. So generally speaking, people call point of control the highest traded price of the day. With a range, you will see there'll be one price with the most volume within that range. Quite often, you'll see the market hit an extreme, come back down. It'll just get back to where that highest traded price is of the range, and it can't get through it and start to move up. If that happens, I'll get out of a trade. Okay, because to me, that's a sign it's going to fail, right? If it is working, usually it's just a grind down, right? There's no pop, right? Even when you get an iceberg at a range, there's really not much of a pop. You occasionally see some acceleration, but that's really the exception. And you will almost absolutely see a slowdown in the middle. So even the range trades that work out, when they get to the middle, that point of control, it generally slows down because that's the area where we traded the most volume. So as it goes through the range from one extreme to the other, you tend to trade a lot of volume again. Okay, these are trades that are a little bit hard to hold on to because they tend to seem like they're not working out. Anyway, as you can see, there's components we can share between trades, and then there's things that are unique to this trade. So we can't always expect the same pop from every setup because every setup doesn't necessarily trade into stops. So with range trades, they become more prevalent in holiday markets. They become more prevalent when, right at the moment, we've got like a lot of days that are high on news, and it seems like the days where we're low on news that the market's exhausted and there's really not a lot of enthusiasm to trade. So on those days, we tend to have more range trades. You'll experience periods where the range trade is the only trade around if you're sticking to one market. And the key to making them work is to be selective in terms of the size of the range, not to get into any individual trade if there isn't a good skew in terms of risk reward. So example, if we just come down here on a shortfall and it's already started to tick into the range, so you know we've seen it lift up a bit, you might want to say, well, you know, the risk reward on this trade is going to be such that I actually need like an 80% win rate to make these trades work. And if you can figure that out at the time and take a step back from those trades, you will actually be better off. Okay, so we have to be a proper range bound market. Helps if we didn't hit the extremes 15 times as well. Okay, so be selective, try and get in early, look for that big volume to cross over from above and below, get the early range trades, and then let the market run. Now, the other range trade is the head fake, right? So you start off with exactly the same range bound conditions. The difference here, though, is on this setup, it's not something you want to take. If it's one of those short ranges where you've got the markets moved up in an uptrend and it's just stopping and it's been in a small lively trend for 10-15 minutes, I wouldn't play a head fake there. So this one has to be a proper range bound market, preferably after the extremes have already been tested a few times, right? So it's a slow market, not a pause in a trend, and that's because this is a manipulation play, and manipulation tends to happen in slower conditions, right? So there's more kind of nudging around of the market at 11 o'clock in the afternoon, heading in the morning, heading into lunchtime and dead days. So basically we start with the same thing. We start with the range and then we move through the range. Okay. Now with a head fake, usually what happens is it's quite a fast move, right? So the first thing you see is as it's moved out through the top of the range, and this could be like the 6th or 7th push through the range, it moves through the top of the range quite quickly and it looks like the range is broken, okay? And you probably have got some stops of people short in this area have fired. That's because somebody's actually pushed the market up, right? And that's probably like somebody that can throw, you know, 5,000 contracts, 6,000 contracts at the market, okay? So now you can see why this is done in quiet periods, because obviously if this is a busy period with a lot of volume, one player can't really push the market around if he's got direction. So you got the push up, you maybe got some short stopping out, you get some breakout traders getting on board, and then 5 or 6 ticks up, market stops, and you get a massive amount of buying that's being absorbed, usually by an iceberg order on the offer side. And then this happens. Okay, so when does this work? Well, we've covered this. It's a slow market, it's lunchtime, it's summertime, it's any slowdown. Why does it work? It's manipulation. Effectively, what's happening is we've been in a range for a while and somebody drives it up through the top of the range just to get people on board. He wants to stop out some shorts. He wants the breakout traders coming in. So you get all these people buying, And then the same guy who bought through the top of the range, he's up here on the upper side, absorbing all the buying, is basically getting into short positions, right? So what's happening, the buyers absorbed by this big fish, breakout traders are now stuck in a bad position. What confirmations are there? Well, this is an interesting trade because this is like a whole cycle. It's like a progression of steps. You got first is the breakout, then you see the stops fire, and then suddenly you see the absorption. And quite often, you know, you might have already had some pushes down through the extremes of the range. Quite often, this will be 5 or 6 ticks below the bulk of volume in the range, but maybe like 2 or 3 ticks below the lowest nudge through the range so far. Okay. If it's not working, you're going to get up past this absorption point, right? You're going to carry on up. If it is working, it's going to go back into the range, and it should carry on to the bottom here. Okay. If it isn't working, it's going to go through the top. The other thing to look for, if it isn't working, is it won't get into the range. Okay, it'll come down here and it'll move up. But if it does that and moves up, you should still be able to get out of a position. Okay. Like I say, if it is working, buying stops at some point, market starts to move down, people bail out, and your first target is really here, and then your second target is the other extreme of the range. Now, if you've been trading in a trading range for a while, like me, you're going to feel a little bit wary of hitting extremes over and over again. So if you're fading the extremes and you're fading the third or the fourth range extreme, fading it back into the market, that's okay, but I'm not comfortable after that. So if like we've been in a range and we've hit the extremes 7 times, I don't want to play it. So at that point, when we hit the range extreme enough times for me to feel uncomfortable, I wait for a head fake. And you see these all the time, right? So because also we've had the extension through the range, we actually have more potential reward, right? So we're still playing the range. We might have been playing the range from here to here and back again. This time, the extension through this head fake actually gives us more potential reward, okay? So we can be wrong about this trade more often, right? We can be wrong about this 66% of the time and still do quite well with head fakes, okay? Great thing about the head fake, the entry point is very well defined. It's not like the other range trades where sometimes it just fades away. The entry point is very well defined, as is your final targets. And one of the things you want to look out for when this happens up here, I mean, it's quite symmetrical sometimes. You'll find that you might head fake 6 ticks through the market on one side, and then later on, maybe not on the next time down, but later on, you'll actually head fake through the market exactly the same amount, okay? So there's times when you can actually get multiple head fakes on the same side of the market. Sometimes it'll head fake up, and then you'll get another head fake up through that head fake, and then you'll get another head fake up through that head fake. Sometimes you get symmetrical head fakes where you'll get a 6 tick on one side and a 6 tick on the other side. Now again, as we range trades, in my opinion, you don't really want to be trading the 4th head fake on one side, right? So a good head fake on one side and a good head fake on the other side, I think is fairly safe. I don't like taking the second head fake on one side, although I've seen them work lots of times. It's just like, I like the early ones. I think they're the safest. I mean, partly because everybody's seen the early ones work already, so it's more of a sucker trade, right? Okay, on to the last trade, if you've been counting. Right, so this one is almost the anti-setup, and I'm going to consider an entirely different scenario, a runaway market. So if you've ever spoken to prop traders, most of them will tell you their results aren't linear. They don't have consistent results across all days. I mean, basically the market doesn't give the same opportunity on every day. So there's a lot of average days, and then there's days where the profits are really exceptional, which is where this anti-setup comes in. So my advice to you is not to get too excited about this today and trade it live tomorrow, right? The best thing to do is sim trade it before you start jumping in, because you've really got to figure out how to manage this one, because it does come with a lot of volatility, right? So you might want to say, well, I'm just going to start, you might want to say, well, for this trade, I'm going to trade the micros and just get in 2 contracts and then add more as it moves my way. Okay, so you don't want to get excited about this trade because there is a lot of opportunity here, but like I don't want to get you excited so you you turn that opportunity into a loss. So the anti-setup is not one, we're not trying to pick a spot, we're not trying to finish an entry. It's simply the ability to understand and recognize that external factors send the markets into overdrive sometimes. You might not see it for a month, and you could see nothing but that for weeks. So if you think about it, August this year, October, November, December 2018, August this year, a lot of the days we've had some really massive days, September as well. And these are the people that give us these days. We'll let Janet Yellen off the hook, I think, now. But most of these people were behind the big days we've had in 2018, 2019. Right, China trade war, Brexit, right, very big drivers of volatility, massive days. The recent stuff with Saudi and the drone attacks, right? So what's happening is you've got a choice on these days. You get in a day, some big news comes in, you've got to basically either get in or not get in. I mean, one of the prop traders said to me, he says, you've just got to pick up your balls and get in, right? I think he meant bowling balls, I guess. What you can't do is you can't use the regular building blocks to construct your trades, right? Trying to fit your existing strategies to a market that has become very volatile. But what we're saying basically is you're going to have moves, news-driven moves that come out of the blue, and they will give you exceptional opportunity. So you'll see your market start to rise or fall rapidly, and sometimes you're going to see that happen without any cause, which is why it helps to have a news feed on hand to look at the moment things start to become very volatile. Okay, so on this particular day, we had big moves in oil, Asian shares and oil. So what is a trade? Okay, first thing to recognize, it's none of the trades we've discussed so far, and it is not trading against the market. Okay, there's a lot of volatility that these news-driven moves come in, and so joining these moves is going to require one or two things. It's going to either require a large stop, or one of three things really: a large stop, some kind of scaling strategy to get in, or successive attempts to enter with a smaller stop. Okay, what tends to be the norm with the trades I know is they scale into larger positions as the move progresses. So basically try and de-risk the trade by starting small. So when does this work? It happens when big news comes in and causes panic or excitement. We saw it today with Brexit, and that causes volatility. Why it works? Simply because markets are not efficient, right? When a move like this starts, when a big move, news-driven move starts, we do not just jump to some kind of value, right? We don't go from trading 3,000 on the S&P, some news comes in, and we just hop to 350 in a second and sit there, right? We see it takes time for the market to move to new value. We also see panic buying and selling, okay? So what confirmations are there? Well, you're going to have two scenarios. You're either going to come into the day, and it's a one-way day based off news, or something's going to happen intraday. Quite often it's a Trump tweet. Today it's been a lot of news off Brexit. You're not expected to pay for a Bloomberg terminal, keep you on the news and watch and react to the news. But what you do is when there is a move that comes out of nowhere, is that you need to have a news feed to hand that you can actually look at and see if the news caused that move, and then make a decision at that point of whether you think that's a move that's worth joining in. Okay, what do you expect to see if it isn't working? Well, the thing with these trades is normally what happens is you get caught on a snapback, okay, after the market gets overextended in one direction. Okay, so you do have to make a fairly quick assessment of how far it's already gone and whether you want to wait for the market to snap back. If this is working, then you're simply going to see the move continues. Okay, so with that extra potential reward, you unfortunately have a lot less confirmation, which is what you should expect basically, but it's not always in line with how we behave as traders. So event-driven momentum trades come with risk and opportunity. You don't have to trade them, but it is one of the things that gives prop traders their biggest days, right? So it is something that if you don't do it now and you're just trying to grind out your 2 or 3 ticks a day, it's maybe something you shouldn't take on. But as you get more experienced with the markets and watching the markets and watching these moves play out, it is something you should have your eye on, maybe, you know, a year, even 2 years down the line, to get into this. You need to have an eye on the news, even if you don't trade these moves, right? So right now, with us being in a very news-driven market state, when you do see a move out of nowhere, you still need to keep your eye on the news feed after you start to see a move come from nowhere, just to see if it's news driven or not. Okay, if it isn't a news driven move, it'll just die down again, right? But if it is a news driven move, you're going to have to change your strategy. So if you're using one of the other 6 setups and big news comes into the market and the market takes off, you really want to back off from those other setups, right? Because they're not going to work in that news driven mode. Because what you'll be doing is you'll be trying to apply setups from your playbook that just don't work in that market state. And that is our 7 setups. Now, I hope this slide makes a lot more sense now. We've seen different setups for different conditions. So obviously you need to understand each day what condition the market is in, right? Then understanding who is going to get caught offside is important because it helps you understand the sort of reaction you need to see to confirm it's working. So if you've seen an iceberg order, then that's going to pop. It's the people in that iceberg that are going to cause your initial reaction, okay? If the market's just moved down and we've run out of sellers, then it's really a path of least resistance and buyers coming in that you're going to see. So if you know that people are going to get caught offside, you know that that's going to give you a certain kind of confirmation. Obviously, if you don't see the pop, then you get out of the trade, right, if it comes back against you. Okay, then if we can also be in the situation where we can have losses and not drain our account, that's also a very healthy position to be in, because you're going to get a losing streak anyway, and if every loser costs you big, then you know you will end up trying to dig yourself out of the hole. You won't react rationally to it. Okay, then you need a healthy dose of repetition. Okay, so even though we had different setups today, they're actually built from a limited number of components. We had the passive least resistance in trending markets. We've had range markets going nowhere, stuck traders, iceberg orders, lack of interest, stop runs. And each new setup you have is going to be composed of a combination of these elements and other elements that you find yourself. So each setup is distinct, and there's usually something to distinguish it from other setups, but there's also overlap, which means if there's certain things that you are good at spotting, then what you should do is build up your playbook of setups based on trades built up with those certain things. So if you're good at spotting icebergs, then you can try the iceberg pullback and you can try the iceberg extreme at a range. But also make sure that you build in a really good understanding of what your risk reward ratio is for that trade, okay? Because you're trading close to a tipping point, which means you should have a skewed risk reward ratio in your favor, which means you don't need a high win rate. So if you start with a trade like that and you start to get disheartened because you only win 50% of the time, but you've got like a 1 to 5 risk reward, but the win rate alone actually puts you off the trade, that alone could mean your failure as a trader, okay? So what you want to do is be able to suffer bad runs without really any adverse impacts. Now, why didn't we look at charts today? Well, simple fact was, I wanted to just think about this in terms of building blocks conceptually before you go back to the markets, to think more about what's going on in the markets and specific chart or order flow patterns. And I also wanted you to not think so much left to right and to start to see lots and lots of convoluted chart patterns as you move left to right, because there really is not that much going on. People are either stuck, people are either getting out, they're getting in, they're adding to the positions, they're taking off the positions. Now, do all this right, take that building block approach to trading. It's going to be a much more effective way to develop your basket of trades than to keep looking for new systems all the time. So it allows you to build up a basket of setups so you can actually engage in different market conditions. So then you've got the challenge at execution time is actually doing the things you've decided to do, to see the things that you've decided to look for, and then actually react in the way you've told yourself that you would, right? So without moving stops, without taking off plan trades, without continuing to trade when the market's just not right for your setups. So the setups aren't really the end point, they're really the starting point for you then to start ironing out your execution and mental issues. So the process of ironing out those issues is going to be a lot easier if you pick the right setups in the first place. Setups where you know what you need to see after entering the trade on the win side, you know what you need to see after entering the trade on the loss side. Without that, without having a clear idea of what you need to see that your trade's working, it is very, very difficult to take a loss, and it's very, very difficult to let a trade run. Okay, so if you take the kind of really old-fashioned way of trading, which is like the moving average crossover, in that trade you can just be in the middle of a move, right? And there's nobody stuck, there's nobody caught offside, there's no real thing to look for that says this trade is working now, except price, right? And if you're in that situation where you've got nothing to say, you know, this is working, or you know this isn't working, it's very difficult to not move your stop and just let price, give price a bit more room, right? If the market has, you know, if you're looking for a pop to the upside, if you've got an iceberg and you've traded in front of the iceberg on the S&P, it's moved up 4 ticks and it just can't get through the 4 tick. It just goes up again and it can't get through that first 4 tick. And then it starts to roll over and then starts to trade just underneath your iceberg. You are done on that trade, right? Without a doubt. Not only did you try to get to the upside and not get the pop to the upside from the guys stuck on the iceberg stopping out, you've also now gone down below the iceberg. In that case, you should be very, very clear and very happy to get out of that trade, right? So having those things to help your decision making really is a lot better than just kind of just saying, well, I'm going to see, you know, 8 tick stop, right? Because it's so easy to say, you know what, I think it's slowing down. I'll move to 9 tick stop, 10 tick stop. And I've seen a lot of decimated accounts doing that. So more signals that you build that help you manage the trade also is going to improve your trading a lot, your decision making and your end result. Anyway, with that, I will open up for questions. So Terry, do we have any questions on that?
All right, if you have questions, type them in and I will ask them. To Pete, stop run, do you mean a move up with a lack of bid?
Generally speaking, if we've moved down and there's an iceberg order, there's going to be a stop run to the upside. Generally speaking, very little trading on the bid side, most of the trading on the offer side, so kind of very heavy imbalance on the sell side, and something that's fast and zippy, right? You know, like 6 ticks in a few seconds. That's what I'd consider a stop run.
Yeah. Can you clarify what an iceberg is?
Okay, an iceberg is an order that refreshes. So so let me just go back to the slides. Just get this here. So basically, you've obviously got 2 kinds of orders: limit and market orders. So in this case, we've got an iceberg on the sell side. So what we'd see is we might see limit orders on the inside offer. We might see 500 limit orders, and then we go up there and we see 500 buy orders trade into that. But we look at the limit orders and there's still 500 limit orders there. So another 500 buy market orders hit that. And there's still 500 there. So another 500. And what's happening as we trade into that price, the limit orders keep refreshing and they keep adding more limit orders, but they're trying to hide it. They're not showing. They might be willing to sell 5,000 contracts, but they're only showing 500. And each time people buy, they just keep adding more sell orders, more sell orders, more sell orders. So it's a way of hiding your real intent. And that's effectively what an iceberg is. And it's just a way of hoovering up contracts. So, you know, if you're selling, you put an iceberg order on the sell side, and as people buy in, you hoover up all those contracts, build a big short position. And then in this case with the head fake, you start selling to hammer it down, and all the buyers get stopped out.
Okay. With the range trading example, would you use the correlation markets with the thinner market Dow, Nasdaq to give you the heads up of when the range is about to finish?
Yeah, okay. It depends on the kind of range. If it's a range where we've been, you know, like a small range in an uptrend, then no. Because generally speaking, what's going to be happening in a small range in an uptrend is Dow's going to be one way and Nasdaq's going to be going the other way. In a more, you know, in a longer term range, like maybe if it's going sideways for like 45 minutes, an hour, you know, lunchtime, that kind of range, a big range, then yeah, I would expect the correlated markets to help. But one of the things about ranges is the correlations do tend to break down a little bit with ranges.
Okay. You discussed price action and volume in the setup. Does liquidity in the order book play a role in your decision, and what are your thoughts regarding the order book?
Um, yeah, I mean, if you think of like Pareto's rule, which is like 20% of the, or is it you get 80% of the benefit from 20% of the information? I think of it like that. I think basically you get most of the benefit from the orders on the in order flow. The depth itself is fake a lot of the time. There are certain places where you will always see more depth. So if you've got a trading range, for example, at the top of a trading range, there will always be more depth on the offer side, and the bottom of the trading range, there will always be more depth on the bid side. Almost always. If you look at a market going back to the high of the day, there will almost always be more depth right above the high on the sell side and right below the low on the buy side. Almost always be massive amount of depth, but it doesn't mean it's going to hold. So yeah, it's interesting, but really what it means is people are looking to play the area. Okay, so if you can be a bit more three-dimensional about it and not just say, oh, there's a big offer up there, market's going to go down. Okay, if you play it like that, you will absolutely. So if you said every time there's a big offer, I'm going to sell in front of it, you will absolutely lose. Okay, if you're a bit more three-dimensional about it, what you would do, if you see a big offer, you watch the market as it approaches that big offer. If people start adding to the offers in front of that one, that means they're front running it. That is a better signal of, okay, maybe I can front run that as well. Okay, but generally speaking, if there's just a big offer there, it's just, to me, somebody's got their eye on that price, so I'm actually going to pay attention to it too. So not really from a perspective of I'm going to make X decision because of the bids and offers, because it's like poker, right? This is like a big game of poker. There's absolutely no reason for somebody to show their hand, right? And so somebody's sitting up there, and it's like on the S&P, somebody just flashing up 5,000 contracts. It doesn't mean they want the market, they're going to sell 5,000 and then the market's going to go down. Generally speaking, if somebody's flashing 5,000 contracts, it means they want to sell 5,000 and they don't care where it's going afterwards. So like one half of a spread trade. Okay, so if you really wanted to, I say just be a bit three-dimensional about it. Realize it means there's kind of interest in it. Might be manipulation. Look what people do ahead of it. So that's generally what I do.
How can you differentiate between new business and old business with regards to range trading, i.e. shorts closing or new buyers?
I don't think you can, to be honest. I mean, if you get to the bottom of the range and you see buyers coming in, then it probably means that people are playing the range back to the upside. But and you know, if you start to move out through the top of the range and you see selling through the top of the range, that's almost certainly not new sellers putting in positions. But generally speaking, you can't tell. And whether it's people exiting or people getting in, that would still move the market. But generally speaking, you take the opinion that buys at the bottom are buyers getting in, and sells at the top are sellers getting in, and buyers at the top are the sellers getting out, and sellers at the bottom of the sells at the bottom of the buyers getting out. So and you just rely on, you can't know 100%, but there's probably a good enough balance, like 60 or 70% balance of those trades to be good enough to move the market.
How do you recognize a typical range day?
Well, you should recognize it coming in. I mean, one of the things that you obviously the lack of news, but also if you're used to watching the same market open every day, you tend to have a very lackluster open. So like a good open on the S&P, you might move like 6-7 ticks straight off the open in the first few seconds, right? But you get a day where you just the first few seconds, it's just like you just stick in the first few minutes, you just stick in a 2-3 tick range. So I look for that kind of thing, a real lack of business at the open, and then of course crossing over those prices. But generally speaking, it's the way it opens that I look at, plus lack of news going in.
What is your opinion on footprint charts versus market profile to find imbalances?
Well, market profile Well, market profile, I just think a market profile is a really good way to take a step back and look back at like 5 or 6 days trading. So it's a real, like, it's like it's the 10-mile high view of the market of where it's been. And of course, what you're going to see there are potential areas where the market might be in a range. So if you look at the profile, and you can see the last 6 profiles from the last 6 sessions are all the same range, then that's going to be a big heads up that you're going to be in a range, right? So I think for market profile, it's really something you look at going into the day. Volume profile as well. I look at the intraday volume profile. So when I say market profile there, I mean the TPOs. When you're using a volume profile, an intraday volume profile, I think that's great in the morning because you're generally going over new ground. So the day's volume profile is absolutely fantastic in the morning, but once you're kind of retreading over that ground in the afternoon, again, it's a little bit less useful, and then you are better off actually switching to footprints later on in the day. But I think earlier on in the day, like if the S&P's been open for 15 minutes, then the volume profile itself is really good to giving you an idea of where people are positioned. But it just falls over. It's literally one column of price and volume. So it's as you keep going over that price over and over again, you're going over prices where people have obviously got out, right? So if you've got a volume profile where you've moved up 10 points and then you go back down 10 points and you're kind of trading close to the open again, you're trading over volume that's already exited. And at that point, you're better off looking at the footprint and just looking at more local action.
On the S&P, do you suggest limit or market orders? I have trouble getting filled with limit orders.
It depends on the trade. I mean, if you're, it really depends on the trade. What I do, I've got like certain trades I can open trade where I'll put limit orders in, sometimes before the market's open or sometimes just after the open. If I'm looking for the market, for instance, to come back to the, if we go back to, where's this trade? The first trade. For this kind of trade, I'd put a limit in, and as long as the market doesn't come down too quickly, just put a limit order in there. Iceberg trades, market order, because I don't think I'm going to join if I join the iceberg, I'm not going to get filled anyway because there's so much in front of me. So I think you just have to do it trade by trade. And also if you're trading like treasuries and stuff like that, then probably again leaning towards market orders. If you trade limit orders, if you're trading crude, you can actually use the volatility to put your limit order in a little bit below where you think a good entry price is, because quite often it'll still the wiggle will get you in. But I think you have to say for each setup, you just have to get the experience to know for that setup, does it typically let me in with a limit order? Whereas for an iceberg, generally not. But for some of these phase where we're coming back to the old range high, as long as you put it a tick or two above the range high, you can just let it come down and sweep you in.
Is the iceberg a better signal than the path of least resistance?
Well, the path of least resistance is effectively part of your confirmation more than anything else. It's part of the reason that a market that's just broken to the upside will continue up. So, if you come down, to here, it's the iceberg that's getting you in, but it's really this path of least resistance that's getting you up to the upside. And it's one of the reasons that, after you've had 6 pullbacks in an uptrend and you pull back to an iceberg for the 7th time, that path of least resistance is a little bit weaker because a lot of people are sitting around saying, oh God, I don't think it's going to go on anymore, or they think the move's over. So I don't think so much one's better than the other. I just think they're just kind of different things you look for.
Okay. Where'd it go? Okay. What is the max market depth DT can display? Is there a way to increase this?
It depends on the market and the data feed. So some of the data feeds are limited to 20. Like Rhythmic seems to have a lot of data. So if you look at crude on Rhythmic, I don't know if there is a limit basically. So you can actually set in the tools we have in the Jigsaw tools, you can actually set the number of levels. So I know you can have hundreds in crude. So we don't have a limit. It's just that some of the data feeds have a limit.
Can you explain what you mean by path of least resistance?
Okay, so if let's say the market's pushed up, and you know you've opened up, the news is good, you know the S&P's moved up 6 points, and then the S&P moves back 2 or 3 points, and everyone's doing exactly what you're doing, right? So everybody in the market is trying to make money guessing what everybody else is trying to do, right? So everybody's sitting there trying to do exactly what you're doing. So let's see the market up 6 points. Let's see like a couple of point pullback, and everyone's like, "Oh my God, is that finished? That 6 point move finished?" And then the market starts to tick up a bit, and then it starts to tick up a bit more, and then different people at different times get the confidence to say, "You know what? This is going again. This is going to break again." And as you get through, like if you look at this case here, it's generally speaking, we know. As the market's moved up, we know as it gets through this whole high, everybody's got the confidence that we're moving up again, right? So everybody knows market moves up 6 points, it comes back a couple of points, then it starts moving up and it moves up another 3 points. Everybody and his dog knows at that point the path of least resistance is to the upside. Everybody knows it's going up again, right? But some people will make that judgment call at different times. So some people only know when it's gone through the high. Some people say that's going up again at different times. It's just it's that path of least resistance saying, you know what, that's going up again. So it's really that feeling. And like I say, the thing to bear in mind is there is no market. There is no other market. Like almost everybody puts on trades, whether it's electronic, algorithmic, or whatever. Everybody's trying to guess what everyone else is about to do, and that's the only thing that makes somebody make a trade. So actually, all the moves are caused by everybody trying to guess what everyone else is trying to do. And it's kind of it's a weird thing to wrap your head around, but that path of least resistance is like, oh yeah, it's going up now. And a lot of times you'll, you know, as a newer trader, you'll get that feeling that, it's going up now, when it's actually too late to take a trade or take advantage of it. So it's just getting into that mindset that there is this thing called path of least resistance, that aha moment that you realize the market's going to move up again.
What is the source of the newsfeed in Day Trader, and how much of the delay is there?
I'm not aware of any delay. It's a proprietary newsfeed that we actually pay for. I can't name it, unfortunately, but it pulls directly from all the news sites. So it's not as fast as Bloomberg, but it is fast enough where if the market starts to move and you go to it, that you'll actually find out why.
Okay. Suggestion for type of setup to focus while starting out. If you had to pick one of these 7, which one would be the one that you would focus on?
If you were starting out right now, what I would say is that if you'd have asked me that question 2 years ago, you've got a different answer. 2 years ago, I would have said pick a setup and work it for 2 or 3 weeks. And the problem is right now, you won't get 2 or 3 weeks consistent volatility. So if you'd gone back 2 years, I could have put you in a setup and said do that for 3 weeks, and known that through that 3 weeks, you'd have had consistent volatility. So I think one of the things you have to do now, primarily, is focus on understanding the drivers behind the market and what is available, right? So I think that's the first thing. If you're a new trader trying to apply anything consistently right now, it's very difficult. So what you have to do is understand, okay, what's driving the market state, and just get yourself to the place where you understand the market state and understand approximately what's on the table. And to be honest, I would start with pullback trades. And the reason I start with pullback trades is it gets you out of that perma-fader mentality where you're always trying to buy when the market's going down. So, you know, what everybody does, you know, the S&P opens, it goes up 10 points. And while it's going up 10 points, everyone's there sitting there with the sell button, the finger over the sell button, waiting to sell it. And then it starts moving down. It moves down 20 points and all the way down there. They've got their finger on the buy button, waiting to buy it. And they're just constantly hitting into the market when it's moving against them. So I think anything that gets you on the side of a trend, but with the caveat that you have to have a clear idea of whether it's a slow day or a fast day. I don't think you can avoid that. I don't know whether we'll go back to more consistency in volatility? I guess we will. But right now, the volatility is so inconsistent day to day. That has to be your primary focus, I think, at the moment.
Okay, he says, often I see big depth building away from the current market level early in the session. Later in the day, we end up trading at that level and into that depth, trading to volume like a target. What are your comments on that?
Yeah, I mean, there is absolutely. I know traders that do similar things on crude, where they'll see depth in certain market conditions. What they'll actually do is they'll put, so they might see a big bid on the sell side, and they'll actually put a sell order, big offer, big limit order offer on the sell side, like 10 ticks up on crude, and they'll actually put a sell order the other side of that, because quite often it'll be a magnet, price will go up to it, trade those contracts, and then fall back down. So I absolutely know traders that do that. It's not what I do, but it is, again, it is only something that only works in certain market states, and I can't tell you what those market states are. With the guys I know, they tend to play that in slower markets when the market slows down a little bit. But yeah, it's absolutely that there is if genuine liquidity exists somewhere, the market will go up and trade it and take advantage of that liquidity. Okay, and so absolutely.
Okay, this is we're getting long on time, so this will be the last question. What is happening when a very large bid offer shows up in the order book and is removed quickly?
I don't know. There's lots of theories about this. I mean, there's theories that it is that they're flashing orders. It's kind of like a fishing expedition, like flashing orders to find other algorithms, that kind of thing. So that's kind of the theory I know. But I don't honestly. I don't know. I don't know. You know, you see bids come and go. I really couldn't give you an explanation personally.
Okay. Thank you for the webinar, the information, and for spending some time with us this evening or morning for you.
Sure. Thank you all, and thank you all for attending.
Absolutely. Thank you.
Cheers.